The global monetary reset has already started. Not might start, not could start, someday, started. And most people are going to miss it completely because it didn't begin with some big announcement or a president standing at a podium. It began quietly with two countries most Americans never think about twice, Japan and South Korea. And a currency market move so big it wiped out something like $1 trillion from US stocks in about 40 minutes. 40 minutes. Not a bad quarter, not a bad year. 40 minutes. And almost nobody explained why. I've been in business and around money my whole life. I've made a lot of money and I've lost a lot of money. And I'm telling you, when you see a move that fast and that size and nobody on television can tell you why in one sentence, that's exactly the moment you need to lean in, not change the channel. Before I get into it, I need you to do one thing for me, and I'm not going to pretend it's some small favor. If you hit subscribe right now, you are going to get a front row seat to the kind of thinking that people usually pay real. Money for, I'm talking thousands of dollars, the kind of stuff hedge fund guys charge for a phone call. You're getting it for free. In plain English, no jargon, no suit. So hit subscribe before you keep watching. It costs you nothing and it might save you a lot. Okay, let's go back to the actual event because the order of what happened matters more than people realize. For months, the Japanese yen had been sliding, not crashing, just sliding, day after day, week after week, like a slow leak in a tire. By this point, it had hit its weakest level against the dollar in about 40 years. 40 years. Think about that for a second. That's not a bad week. That's a multi-decade low. And when a country's currency slides that far for that long, it's not some abstract chart line. It means everything that country buys from the outside world, oil, food, parts, whatever, gets more expensive for them, and everything they sell to the outside world gets cheaper for everyone else. It's a country quietly getting poorer in slow motion. So Japan finally said enough. In a single day, their government spent somewhere north of $50 billion buying up their own currency to prop it up. One day, $50 billion. That is the largest one-day currency intervention in recorded history. Not close. And normally, that would already be the headline of the year. A country spending that kind of money, defending its own money, is a 5-alarm fire in the financial world. But here's the part that should really get your attention. The United States joined in. And I want you to sit with that for a second, because America has not done that with Japan in almost 30 years. 3 decades of staying out of it. And suddenly the New York Fed, acting on behalf of the US Treasury, starts buying yen too. That's not a normal Tuesday. That's a signal. That's 2 of the biggest economies on earth, basically, admitting in public that something underneath the surface had gotten uncomfortable enough that they had to act together. And it wasn't subtle either. Around the same time, a photographer caught a shot over the shoulder of the Treasury Secretary during a meeting, and on his notepad, plain as day underlined, it said, "Buy yen." Not a rumor, not some anonymous source. A photograph of a handwritten note from the guy who runs the department that actually does this stuff. Now, here's where it gets interesting, because this is where most people stop paying attention, and it's exactly where they shouldn't. In the very same stretch of days, on the other side of the world, the South Korean stock market had its single worst month in its entire history. Worse than 2008. Worse than the Asian financial crisis in the 90s, which for anyone who lived through it was absolutely brutal. Worse than both of those. In the same window that Japan was spending record money to defend its currency and the US was jumping in to help, most people look at that and see 3 or 4 unrelated stories. A weird photo, a wobble on Wall Street, a crash in Korea, different headlines, different countries. Nothing connecting them except bad timing. I'm telling you, from years of watching money move around this planet, that's not how this works. When you see multiple currencies and multiple stock markets all crack in the same tight window, you're not looking at 4 separate stories. You're looking at one machine, and you just watched a piece of it fail. So what is the machine? It's got a name, and it's a boring one, which is exactly why nobody outside of Wall Street ever bothers to learn it. It's called the carry trade. And once you understand it, really understand it, not the textbook version, the plain human version, You will never look at a random market crash the same way again. Here's the simplest way I can explain it. And I've explained a lot of complicated financial ideas to a lot of regular people over the years. So bear with me. Imagine you could borrow money for basically nothing, like next to zero interest. That's Japan for the better part of 30 years. Interest rates near zero, sometimes below zero. Now imagine you take that nearly free money, convert it into another currency, and go put it somewhere that actually pays you something. US bonds, US stocks, emerging markets, real estate, doesn't matter, anywhere. With a real return, you're borrowing for free in one country and investing for profit in another. That gap between basically free to borrow and actually pays a return is the trade. It's called carry because you're carrying money from a place where it's cheap to a place where it's valuable. And this isn't some fringe strategy a handful of traders use. This has been one of the biggest, quietest trades on the planet for decades. Trillions of dollars, not billions, trillions, built on top of the simple bet that Japan would keep rates near zero forever and the yen would stay weak forever. When both of those things stay true, this trade prints money quietly, safely, for years at a time. That's exactly why nobody talks about it. Boring trades that just work don't make headlines. But here's the thing about any trade built on this will stay true forever. It never does. Eventually, the country lending you the cheap money changes its mind, and when that happens, the whole trade has to unwind. Fast, because everybody borrowed the same cheap yen to make the same trade, and now they all have to pay it back at the same time. Think of it like this. Picture a massive game of musical chairs, except everybody's chair is made of borrowed money. As long as the music plays, everyone looks like a genius. Rates stay low, currency stays weak, and the trade just works year after year. But the second Japan decides to raise rates or defend its currency, the music stops. And now everybody holding that trade has to sell whatever they bought. Stocks, bonds, anything. Convert it back into yen and pay back what they borrowed, all at roughly the same time. That's not a slow walk to the exit. That's everyone trying to fit through the same door at once. That's 40 minutes. That's your $1 trillion gone from US stocks before lunch. It wasn't some terrible earnings report or bad economic data. It was leverage unwinding all at once. Because the cheap money that funded half the trades on the planet suddenly wasn't cheap anymore. I want to make sure this actually sticks. Because I know carry trade sounds like something you can nod along to and forget by tomorrow. So let me put it in terms anyone who's ever run a business or carried a credit card balance will understand. Instantly, imagine you took out a loan at basically 0% interest and used that money to buy something that pays you 8 or 9% a year. Every single year you don't have to pay that loan back. You're pocketing the difference for doing almost nothing. That's a great deal, right up until the lender calls the loan or jacks up the rate. And suddenly you owe real money on a debt you'd stop thinking about as a debt at all. Multiply that by every hedge fund, every institutional desk, every big player on the planet doing the same trade with the same cheap yen, and you start to understand why the unwind isn't gentle. It's not one guy quietly paying back a loan. It's thousands of players racing for the same exit at the same time, and the price of everything they're holding gets crushed in the stampede. And why did Korea get hit even harder than the US? Because money that flows out looking for a return doesn't just go to America. A huge amount of it goes into emerging and export-heavy markets like South Korea, chasing growth, chasing yield, chasing whatever's working. When the carry trade unwinds, that money doesn't leave gently. It leaves the way water leaves a boat with a hole in it, fast, and from wherever the hole happens to be. Korea had a lot of that hot, borrowed money sitting in its markets, and when it left hard. Here's why I keep saying this. Always start small and overseas before anyone at home notices. And it's not a coincidence. It's just how money works. The biggest cracks almost never start in the country. Everyone's watching. They start in the plumbing, the currency markets, the interest rate spreads, the boring stuff nobody outside of finance pays attention to. By the time it shows up as a headline about your own stock portfolio, the actual event already happened somewhere else days or weeks earlier in a market you weren't even looking at. I've seen this pattern before more than once over a long career of watching money move. A currency does something strange. A central bank makes an unusual move. Some overseas markets have had a terrible week for reasons that don't make sense yet. And people shrug it off because it's not their country, not their stock, not their problem. Then a few weeks later, the same pressure shows up somewhere closer to home. And by then it's too late to prepare. You're just reacting. I'll be honest with you. I made this exact mistake myself earlier in my career. I looked at a strange move in a foreign bond market and thought, that's their problem. That's on the other side of the planet. It has nothing to do with what I'm doing. A few weeks later, the same pressure showed up in a completely different asset I actually owned. And I was left scrambling to figure out why, instead of already knowing why, because I'd connected the dots earlier. That lesson cost me real money. And it's the reason I pay so much attention to this stuff now. The market doesn't send you a memo that says, hey, this thing happening in Japan is going to hit your portfolio in 3 weeks. You have to go look for the connection yourself because nobody's going to hand it to you, especially not the people on financial television whose job is to fill airtime, not to actually explain the plumbing. That's exactly why Japan and Korea aren't the whole story. They're the opening chapter. The forces that just cracked those two markets, decades of cheap, borrowed money, currencies stretched way past what makes sense. Trillions of dollars of leverage built on the assumption that nothing would ever change. Those forces don't respect borders. They exist everywhere. Every major economy has some version of this same setup, some pile of debt, some currency under pressure, some trade that only works as long as the music keeps playing. Now let's zoom out, because I don't want you thinking this is just a Japan and Korea story, because it's not even close. This is bigger than two countries, and it connects directly back to something a lot closer to home, which is the US dollar and the mountain of debt sitting underneath it. For decades, the dollar has been the center of the whole system. It's the currency the world uses to price oil, to settle trade, to hold as a safety net. That status gives America enormous advantages. We can borrow more, cheaper than almost anyone else on earth, because the whole planet wants to hold dollars and dollar debt. But that advantage isn't free, and it isn't permanent. It exists because other countries trust the system enough to keep participating in it. Here's what should make you pay attention. Right now, a lot of countries are quietly working to depend less on the dollar for trade, for reserves, for settling deals with each other. Not loudly, not with some big announcement, just steadily, deal by deal, over years. At the same time, US government debt keeps climbing to numbers so large they barely mean anything to a normal human being anymore. Trillions stacked on trillions. And the interest payments alone are becoming one of the biggest line items in the entire federal budget. None of that happens in a vacuum. When the country at the center of the system is carrying that much debt and the rest of the world is slowly hedging its bets away from total dependence on that system. You don't need a crystal ball to see where the pressure builds next. I'm not telling you the dollar will collapse tomorrow, and I'm not telling you to panic, because panic is how regular people lose money, not how they protect it. What I am telling you is this. What just happened with Japan and Korea is what it looks like when decades of cheap money and stretched currencies finally hit a wall. And the exact same ingredients, too much debt, currencies under strain, trillions in leverage built on assumptions that stop being true, exist right here too. Korea and Japan didn't create a new problem, they revealed one that was already sitting there. Think about it like a house with a slow foundation crack. For years, nothing looks wrong. The paint's fresh, the floors are level, everyone walking through says it's a beautiful house. But underneath, the crack has been growing the whole time, quietly, out of sight, because nobody's looking in the basement. And then one day, a door that used to open smoothly starts sticking, and a window won't quite close, right? Small stuff, easy to explain away individually. That's Japan's currency at a 40-year low. That's Korea's worst month in history. Small, explainable, individually, easy to write off as unrelated. But when you start seeing several of those small signs in the same season, That's not decoration problems anymore. That's the foundation talking to you. And the people who ignore it are the same people shocked when the whole thing finally settles all at once. And here's the part that I think gets lost in all of this. This isn't really about Japan or Korea or even the dollar specifically. It's about what happens to any system, any country, any company, any person when they build their entire structure on the assumption that cheap, easy conditions last forever. They don't. They never have. Not once in the history of money rates that stay low forever. Currencies that stay weak forever, debt that never has to actually get paid down. None of that is a law of nature. It's a temporary condition that eventually corrects, sometimes slowly, sometimes in 40 violent minutes on a random Thursday. So here's what I actually want you to walk away with, because information without action is just entertainment. And I didn't sit down to entertain you. I sat down to help you. First thing, stop thinking about your money in only one currency and only one type of asset. If everything you own is priced in dollars and sitting in one country's stock market, you are betting your entire future on one horse in a race where the track conditions just changed. That doesn't mean go do something exotic or complicated. It can be as simple as owning some assets that don't move in lockstep with US stocks, some real assets, some international exposure, something that isn't correlated to the same forces that just took $1 trillion out of the market in 40 minutes. Second, pay attention to interest rates and currencies the way you pay attention to earnings reports, because they matter just as much, arguably more, and almost nobody watches them until it's too late. You don't need a finance degree for this. You just need to notice when a central bank changes direction, because that's usually the first domino, not the last. Third, and this is the one that matters most, don't be the beginner who panics and sells at the bottom because the headline scares them. Every single time I've seen a crack like this, the people who get hurt the worst aren't the ones who understood what was happening. They're the ones who had no idea, got scared by the noise, and made an emotional decision instead of an informed one. The pros aren't smarter than you. They just aren't surprised because they understood the mechanics ahead of time. That's the entire game. Understanding beats guessing every single time, in markets and in life. I want to say this as plainly as I can because I've watched too many good, hardworking people make this exact mistake. The person who worked overtime for years to build a small nest egg, who finally got comfortable putting money into the market, and then watched a week like the one we just talked about and pulled everything out in a panic. That person almost always loses twice. They lose on the way down because they sold at the worst possible moment. And then they lose again months later, watching the market recover without them because they were too scared to get back in. Meanwhile, the people who understood what was actually happening didn't sell a thing. Some of them added to their positions because they knew a leverage unwind isn't the same thing as a company losing its value. It's forced selling, and forced selling ends. It always ends. So the question is just whether you're the one being forced to sell or the one calm enough to watch it happen and act with a clear head. And fourth, treat this as the opening chapter, not the whole book. Japan and Korea are not some isolated foreign news story you can scroll past. They are the early warning system for a much bigger shift in how money moves around this planet. The smart move isn't to react to the next headline. It's to understand the machine well enough that when the next crack shows up, wherever it shows up, you already know what it means and what to do about it. One more thing I want to leave you with, because I think it matters more than any single tip. Nobody is going to protect your money for you. Not the news, not your broker, unless you're paying them very well to actually pay attention, not the government, nobody. And the people who came out ahead in every version of the story I've ever watched play out were the ones who took personal responsibility for understanding how the system actually works, instead of waiting for someone to explain it to them in the middle of the crisis when it's already too late to do anything but react. That's not a pessimistic message. It's actually the opposite. It means you don't need to be a genius and you don't need an inside connection at some big bank. You just need to be willing to learn the mechanics before everyone else bothers to. And that alone puts you ahead of almost everybody watching this right now. So here's my challenge to you, and I mean this. Don't just watch this video and move on to the next thing in your feed. Go find one thing in your own financial life this week. One account, one investment, one habit that's built entirely on the assumption that nothing ever changes. And ask yourself honestly if that assumption still holds up after everything I just walked you through. Write it down. Actually do it. Don't just nod along and forget by tomorrow. If this video connected some dots for you that nobody else was connecting, do me a favor and subscribe, because I'm going to keep pulling these threads as this thing unfolds. And I promise you, it is nowhere near finished. Drop a comment and tell me which part surprised you most. The $1 trillion in 40 minutes, the notepad, or the fact that nobody in the mainstream financial media bothered to connect any of it for you. I read every one. I'll see you in the next one.